Hello everyone, today we'll be discussing adjusting entries. In accounting, there are two possible bases for recording revenues and expenses. Firstly, we've got the cash basis, which records revenue when cash is received and records expenses when cash is paid. So for example, on 1st of January, Woody purchased $30,000 worth of supplies for his toy factory. So we would debit supplies $3,000 and credit cash $3,000. And secondly, we've got the accrual basis, which records revenue when they earned and records expenses when they incurred. And this is what I will discuss with you today. On the accrual basis, we adjust the original or general entry, so therefore it is called adjusting entries. There are 4 scenarios, 2 for revenue and 2 for expenses. For revenue, we've got deferred revenue and accrued revenue, and for expenses, we've got deferred expense and accrued expense. For revenue, with deferred revenue, cash is received before the revenue. So for example, the cleaning company receiving money for its service for the whole year. And we've got accrued revenue, where cash is received after that revenue. And the example for this is to say that the cleaning company cleaned the office first and then billed the client for their service. And for expense, we've got deferred expense when cash is paid before the expense, which is the factory prepaying its rent for the whole year at the beginning of the year. And we've got accrued expense when cash is paid after that expense. So say an office that uses their computers in their operations and they pay for the bill after the month. So back to the first example where we bought our supplies, say June 30th, which is half of the year, the Woody's factory used half of the supplies, so we would debit supplies expense at $1,500 and we would credit prepaid supplies at $1,500. So how did we know that, and how do we master adjusting entries? Well, my advice is for this table. So with this table, it is important to note that adjusting entries never involve cash, as depicted in the column, and we've got the lines for the account names in this table indicate that you must use the specific account names. So the steps include: first, you identify which scenario it is on the table, and secondly, you identify the general journal entries with the correct account names, and thirdly, you look at the adjusting entry column for adjusting entry accounts, and fourth, you just reciprocate and write down the specific account names. So say on 1st of January, we paid $4,000 for 1 year's worth of rent for the toy factory. So first, we identified the scenario as deferred expense, and secondly, we found out that the original entry is debit prepaid rent $4,000 and credit cash $4,000, and the adjusting entries would be debit something expense and credit prepaid something. So therefore, the adjusting entry at 30th of June, which is half of the year, will be what it is in the adjusting entry column, which is debit rent expense $2,000 and credit prepaid rent $2,000. Thank you for listening!